One is not yet. And we are recording the meeting. So if anybody is not here, that they can view it afterwards. So this is another one of our wealth building masterminds. I am happy to host these this year to talk about how we can help you build your wealth. This is meant to be educational and a mastermind experience. We've talked a lot about net worth. We've had some great guests on. And so today I have asked Mitch Brill to come on. Mitch is with Altium Wealth Advisors. Mitch advises me personally and a lot of people that I know, helping me to grow my wealth. And Mitch is here, and hopefully we're going to be joined by Eric Bickneys also to talk about another form of investment for either you or your investor clients, and that is Delaware Statutory Trusts or DSTs. And this is another vehicle for an investor to do a 1031 and get a fractional ownership interest in a larger scale investment that they might not have been able to buy just through their own 1031, and to also to not have the management responsibility, but to get a good return. So I will allow Mitch to come on now, if you would, and please introduce yourself. Tell folks anything you'd like to that I haven't hit on about you and what you do, and then we can get right into the DSTs.
Awesome. So thank you very much. Thanks for having me. Really appreciate it. As Rosemarie said, I'm a partner at Altium Wealth Management. That's the name of my company. We started in about 2010. The reason we started Altium, I'll just give you that really quick background, is that before that, myself and three of my partners were with broker-dealers. And when you're with a broker-dealer, your fiduciary responsibility is actually to the broker-dealer. We thought that was misplaced. So we formed Altium as an RIA, a registered investment advisory firm, under the auspices of the SEC, so that our fiduciary responsibility is to our clients. As part of that, what we really do is we're financial consultants. So we really look at everything the client has going on, and I'll get to why this is important in a second, but we look at everything the client has going on and really plan out the cash flow basically for the rest of their life. Because if a problem is going to exist, you'd want to know about it sooner rather than later. So think about in the exchange area. Let's say someone's got a building and they've had the building. Let's say it's a warehouse for a number of years. Over time, they're depreciating the building. At some point, the building has a zero basis because they've completely depreciated it. And now they want to sell it. The one thing that's going to stop them from selling it really is, or one of the things anyway, is the taxes. So we've advised a bunch of clients through the exchange process. First, they identify they've got a building that is no longer performing, or they don't want to do anything with it, and they have to figure out what to do. So they decide they're going to sell the building, and then they've got to go through the exchange process. If they're going to, so let's say it's a $5 million building in New York, they want to sell the building, they're going to get hit with significant taxes. Could be, well, you're going to pay federal taxes and New York state taxes. So you really could be up to 35 to 40% of whatever the sales price is in taxes now, because your basis has gone to zero. So one thing that the IRS code allows you to do, at least right now, and I say right now because there are proposals afoot that would do away with this, I think it would significantly hurt the real estate industry or the commercial real estate industry. So I think that when everything pans out, this is something that will stay, because I think that exchanges are really good for real estate in general. But we'll see what the Biden administration in Washington thinks about that. There's always the sort of runaway part of the party that wants to get rid of everything. And this is viewed as something that helps the wealthy rather than helping the not as wealthy people. So that's why it comes under scrutiny. So the way the exchange works essentially is you sell the property. Within 45 days of selling the property, you have to identify the property they're going to move into. or that you're going to purchase, and you have to close within 180 days. So the way that it would work is, let's say we go back to the $5 million building with the zero basis, right? You would need to find a building or a Delaware Statutory Trust or investment real estate that at least has a value of $5 million. If it has more, then you'd have additional basis. But let's say it's two $5 million buildings, you'd sell one, you'd roll the proceeds into the new $5 million building that you're buying, and you would have had the carryover basis from the first building. So you'd avoid any tax. But now in your new building, you'd have a new building which is hopefully producing more income or what have you to you. Or you could have increased to a $10 million building, and you'd again have $5 million more of basis in which to depreciate, which is one of the reasons why real estate is really attractive. So any questions so far? And I'd love this to be dialogue. So if you have any questions about that, because otherwise this is going to be really quick. So now, if there are any questions anywhere along the way, please unmute and share with me. So now we've got let's say you decide for whatever reason, I don't really want to be in real estate anymore. So when does that happen? I'll give you an example I think it happens on two ends. One end is the person who's been managing their real estate all along says, you know what, I don't really want to be responsible for managing the building anymore. I just saw the chat, so I wanted to make sure I checked it. I don't want to be responsible for managing the building or the real estate anymore. So I want to either do one of two. Well, actually, there's only one answer to that, and that's the Delaware Statutory Trust. Keep in mind what a lot of people have done in that spot is they've said, you know what, I don't want to take as big a role in managing the building. So what I'll do is I will do the exchange, but I'm going to exchange into a triple net lease property. Now, I know when you all took your test, you learned what that was, but just in case, triple net lease is really a situation where the tenant, let's say CVS or Walgreens, because those are normal ones, take care of all the taxes, the maintenance, and the insurance. So you don't have to do as much in terms of managing that piece of property as you would if it was just a warehouse or something like that. The challenge with that becomes, as you get to the end of the triple net lease, your property could become a little less valuable. So some people are looking to exchange properties or renegotiate with the tenants as the triple net lease starts to the time of the triple net lease starts to dwindle down. So one option, if I'm willing to do a little bit of work but not a lot of work, is the triple net lease. But a lot of families, and I'll tell you a story in a second, will say, you know what, the person who used to manage the real estate is no longer here. We've inherited the building or whatever it is, and we don't really know that much about real estate, so we don't want to pay the capital gains tax. And in that kind of case, the Delaware Statutory Trust is the answer. So let me give you an example, and then we'll talk about the DSTs a little bit. So an example of that is a client that I'm helping right now. So bear with me for this long story. Her grandfather owned the building. Her grandfather dies, transfers the building to the father. So what happens? It gets a step up in basis at that point, because that's the current law. So now dad's got the building for a bunch of years and starts depreciating it all over again. Dad gets divorced. So he has one child with his first wife. Then he gets remarried, has another child with his second wife. Dad dies, leaves half the property to the second wife and half the property to the one child from the first marriage, one child from the second marriage. So really complicated fact plan, right? The building was already in sort of disrepair. The kids come along and say, you know what, we don't really want to manage the property. It's also half in a trust, half out of a trust. So it's a mess. So the kids get together and say, you know what, we don't want to manage the property. We don't want to roll it into a triple net lease because we don't want to manage that either. So the other option is something that hasn't been around for that long, but it's been around for at least 10 years, is something called the Delaware Statutory Trust. So what is it? So the way Delaware Statutory Trust works is there's several, I'll call them organizations that specialize in Delaware Statutory Trusts. There aren't a lot, and there aren't a lot of great ones. But what they do is they they have ongoing deals along the year. And what they do is they identify property. They're essentially management agents. They identify property and they let people roll their basis from the property they're getting rid of into the Delaware Statutory Trust. And they put a bunch of people's money together and then they buy real property. And they buy real property. It's short term. It's usually 4 to 7 years, and then it'll roll over again. So if the cap rate on a triple net lease were, let's say, 5%, the cap rate on the Delaware Statutory Trust is going to be probably 4% because there are a lot more expenses that go into it. There's a broker, and that's what Eric did basically, who will not be on. I found out will not be on the call today, but hopefully I can do Eric's part for him. So the way Delaware Statutory Trust works is the person who's putting the deal together gets a bunch of different people who are in this similarly situated. They identify within 45 days, close within 180, and there are a bunch of shareholders in Delaware Statutory Trust property. So the Delaware Statutory Trust property will throw off income. The investor doesn't really have to do anything. And then when the deal is over at the end of the 4 to 7 years, you will then roll into probably a new deal, or at that point you pay the tax. And essentially that's really how it works. There are a lot of nuances. There are things to be careful of. So what are some of the things to be careful of in the Delaware Statutory Trust? You want to work with a really good someone who knows what they're doing in the Delaware Statutory Trust area, because as you can imagine, there are a lot of compliance issues and things like that. So you want to work with a good funder. And you probably want to work with someone like Eric, who's again not on, who understands and sees a lot of deals, so they can help pick out the couple deals that are best for you, and make sure that they're right. It's a good idea to spread the money out rather than just do one deal. So that's challenge number one. Challenge number two with the Delaware Statutory Trust is that it's going to end. You know that at the end it doesn't really have the ability to borrow more money. So what they do is they get the property in a better situation and then they sell it. So that time period is probably going to be about 4 to 7 years. So you're probably going to have to go through the Delaware Statutory Trust scenario all over again. But just to give you an idea, if we go back to the situation that I was talking about where dad died, mom has half the property, the other half the property is in trust. When mom dies, it's going to get another step up in basis. So you might not want a Delaware Statutory Trust that's really long, has a long tail. You might want a shorter tail Delaware Statutory Trust. If it's you and it's going on, and you're young, you might want one with a longer tail because you don't want to have to go through it all over again. In the 4 years, it might be better to wait till 7. So that's really how they work. You can expect a little lower rate of return, probably 4% right around now. There are a lot of good funders or managing agents out there that do this, but essentially that's how the Delaware Statutory Trust works. So I've talked for a while now. What questions do you guys have?
So we have a question in the chat, Mitch. This is from Michael. With the 4 to 7 year rollover, does the investor get to pick the project and the length, or does DST make that decision?
They pick the project. So the money can come out to you again, but you get to put what you're going to put the money back into. So you would look at either another Delaware Statutory Trust, or maybe at that point you've got your feet wet in real estate and you do either an investment property or a triple net lease or something like that. So it's not stuck in there forever. So there is some flexibility. The problem is that there are times of flexibility, and that's when the deal ends. When the funder decides, okay, we're going to sell this property now, whether it's multifamily, things like that.
Okay, so when you go into the DST, do they say upfront how long it's going to be?
So they can give you an idea, but they can't really tell you for sure because it really depends on the market. If 2008 comes along and no one's buying anything, then they might end up keeping it for a while. It's really when they would when typically an investor would refinance, that's when the deal is going to end. And you could do another DST, you could do investment property or triple net lease, or you could just pay the tax and take the money.
And so, and then the other part of Michael's question is, so if the investor, if they decide that they want to get out of the DST and buy something on their own, is there a penalty for that?
So unfortunately there is, and you're really stuck with, it's kind of like timeshares, right? You buy the timeshare, and if you want to get out of it early, if you want to get out of it, there's a market, but the market's not nearly as good.
Mm-hmm.
So in the DST world, if you want to, there are people who will buy people out of DSTs, but they're not doing it for $1 on the dollar. They're doing it at a discount.
Mm-hmm.
And that's the problem, but really good question.
Right.
The problem with the DST is that you're kind of locking up for a period of time. Although if you bought a triple net lease or investment property, you're really doing the same thing and you're subject to the whims of the market. But the alternative is paying a boatload of capital gains tax, and no one likes that either.
Right. How can we learn more about this and start working with investor clients?
So there are definitely websites, and there's tons of information on DSTs on the internet. I can certainly, and I'll make it a follow-up, Rosemarie, to follow up with you and get you some educational stuff.
Okay. And we'll post that on, we have our Think Wealth Thursday Facebook group. So hopefully all of you who are on here are part of that. Again, that's Think Wealth Thursdays. And if you're not on it, join the group, and I will post links to anything that Mitch sends me in that group.
And what I'll also send, because I think it's important, the DST is one alternative when you do an exchange. I think the more important thing is to really drill down on the exchanges and how they work, and have you gone over ever what a qualified intermediary is, or any of those kind of people?
I think generally we have not done it here, but I know that we have had classes before on it in the market center. We haven't done anything that recently, but I do think that a lot of our agents are familiar with the 1031 exchanges. I think one of the problems right now in the market, again with the inventory so tight, is and the values up so high, is we do have a lot of investors who want to get out of their current properties. The problem is that they can't find replacement properties.
Right.
Or you also have some coming out of 1031s in an entity, in a sub S entity.
Yep.
And the partners breaking up. And then the question is, what do you invest in then? So I have a question about the DSTs relating to that. If you come out of it, can one partner, does it have to be the same entity that invests in the DST, or can it break up?
So it's going to go by the same rules as basically it's exchange rules. It's not the DST rules. So if the exchange rules allow it to break up, and you to take your part of the basis and roll into DST, or to the triple net lease, or to fee simple absolute, it will work the same way.
So then for that investor, really the only thing, and I think that that's ending this year, is the opportunity zone.
Right.
So, and that's something we can talk about on another call, is opportunity zones and investing in those. I actually did that myself, as you know, Mitch,
Yep.
a couple of years ago, because we had that very scenario. So I'm going to go, we have a bunch of questions, so I'm going to go through them here
Awesome.
with you in the chat. What are the tax implications of any profits within the DST?
So the DST is going to throw off income to you because someone's renting the DST property from the managing agent. So that's going to come off as basically as income. There'll be some expenses to offset it, and if you have basis left, you could use the basis the way you would normally do in any investment property.
Mm-hmm. Okay. Someone has asked, Jonathan is asking, do the same rules apply to residential multifamily as well? So yeah, so all the different product property
Right.
categories can be in a DST. It could be
Yep.
commercial, multifamily, office, industrial, anything. It just depends on the specific DST, right?
Correct. Investment property is investment property. And then the conglomerate that's going to find the new properties are going to find things like multifamily, hotels, whatever it is, commercial property.
Okay. Can there be multiple properties in the DST, or is it always one property?
It's usually more than one property. So there is some, you're diversifying your risk a little bit,
Okay,
which is good.
all right. Who has other questions for Mitch? Any other questions? Eileen has posted the Facebook group in there. Think Wealth Thursdays. So, Mitch, what else do you have to tell us?
I mean, that on the DST thing, it's pretty narrow. So that's, keep, the other thing I would say is be weary of legal changes, but I mean, that's going to affect your business anyway. But look, I would say that everything's on the table, whether the current administration gets what, and I'm not sure that I don't want to be political here, but I don't think that the current administration is as far out as the left part of the party. But the progressive part of the party, let's say, the progressive part of the party, though, is really giving the more moderate part of the party a really hard time here. So there are things like exchanges and things like conservation easements and stuff like that that are really going to come under some scrutiny in the not too distant future. But so I don't want to get far afield, but think about it this way. I don't know if you're familiar with conservation easements. They're kind of cool, so I'll explain a little bit about them. The way a conservation easement works is that if you take a piece of land, and there are also companies that do this, you take a piece of land and you say, I'm going to conserve this land forever. So let's say it's now going to become part of a preserve, or it's a place where people can ride motorbikes and go hunting and fishing or whatever. Let me get to why. Keep in mind that when President Biden ran for office, one of the big things that President Biden talked about was green space and the environment and things like that. So conservation easements, the way they work essentially is you donate that land to the conservation easement. And when you donate the land, you donate it at its highest and best use. So let's say it's believed that there's diamonds or oil under that property. Well, that property could either be a conservation space or it could be a diamond mine or an oil mine. And an oil mine, that property would be really, really valuable. So, but it's now going to be conservation space. So you would get a deduction based on the oil possibility under that land, not on the deducting it as a conservation space. So what ends up happening in areas like New York and California, which are really high tax states, and I was just speaking about this to someone earlier, is let's say you put $1 million into, give it to one of these companies to find land and donate it for conservation easements. Well, you're going to get a deduction of north of $2 million if you do that. So you can imagine that the administration that wants to generate money, because the country needs money, is going to say these conservation easements are a terrible idea. We should get rid of them because the wealthy people are using them as a tax avoidance scheme. You understand that, right? I mean, okay. So, but here's the flip side to that. The National Park Service got started under Teddy Roosevelt's administration. And the conservation easements probably started in like 1980, 1990. So from 1980 to present day, there's more parkland or conservation space than there are national parks. So in terms of green space, the current administration is in a little bit of a quandary. They want people to continue donating land for conservation easements, but they don't really want, because it's a good thing. There's more land. It fits with everything they want to do except for one thing: raising taxes. So that's what they're struggling with in Washington right now. And the same thing is true in the 1031 exchange piece, because, on one hand, they're saying, well, real estate owners are avoiding taxes. They're not really avoiding them, but they're avoiding taxes. So what do we do? And the other issue there is, right now, when people die, their assets get a step up in basis at death, which means there's heirs inherit those assets at the date of death value. In Washington, there's definitely been proposals to get rid of that step up in basis, which changes the 1031 exchange piece and a lot of other pieces along the way. Because if you get rid of the step up in basis, it actually would be better for some people to sell property before they die, rather than dying with the property and letting the family sell it or passing it to future generations. So it really has a longer impact than anyone's considering when they just look at taxes or conservation or any of those things. So I guess the watchword here is be wary of what could happen. Even the Trump administration changed taxes, and a lot of my clients ended up paying a lot more taxes than they were before, unless, of course, they were real estate investors. So that's the way that administration went. So we're less than a year into the new administration, and it probably will unfortunately affect their business a little bit, depending on what they end up agreeing on. So I tried to not be political. I hope I wasn't.
I think what we can all agree on is for sure that if the 1031 exchange goes away, it is going to massively affect the real estate market, because there are tons of these deals being done every day, and there are lots and lots of investors who are putting money back in to the economy through development and through the 1031 exchanges. So that would be very impactful.
True, Lori. Good job.
Yeah, death and taxes. Yeah, Lori in the chat. Tell us for a minute, anybody can type in any more questions on this topic for sure. But I know, Mitch, that over the years, you and I have talked a lot about interest rates and, what you see happening with them, from your side of it. What do you see, going forward with the bond market and with interest rates?
So I guess the Fed has said they're going to leave it alone for a while. And certainly the economy is kind of heated up. But I really think, so they've said they're going to leave it alone. I think at some point we get some inflationary pressure, because we printed a lot of money in the last 2 years, and somewhere that's got to get paid for. The challenge is that the country can't afford that, because look at the debt. The debt keeps going up, and now even more so because of COVID, but the debt keeps going up. So if interest rates go up, the government's going to owe a lot more money. So although the Fed isn't technically a governmental entity, it definitely will affect, and has some. I think there's certainly some political piece to the Fed, but I think that in the near term you're going to be okay. Couple watch things. Let's see what happens in September, when people kind of have to go back to work and might not want to in person, and unemployment gets trimmed a lot. Let's see what happens. I think in the short run you're going to see inflation, and the reason you're going to see inflation is because during COVID there wasn't as much international commerce as there could have been, and people didn't order stuff. So I'll tell you, you've seen what's happening with cars right now. They can't get chips. Same thing is happening in trucks, meaning computer chips, to make sure they run the way we want them to run. So if you're going into a car place, I just looked at a car the other day, and there are no deals. It's like you can take it for the sticker price now, or thank you. But and used cars are really expensive. I was also talking to someone who is a president of one of the divisions of Phillips Van Heusen, which is a clothing company. They do like Bass and Lacoste and all those. And he was telling me that when it comes to Christmas time this year, there's not going to be anything left on the shelves. And I said, that's amazing. And he said, no one ordered anything, so we didn't manufacture it. So anything that they're ordering right now, and he's actually my former brother-in-law. So I was seeing him about a month and a half ago. And he said, anything that they're ordering right now, I can't produce and get here till February. So if there's something that people want to buy their family for Christmas, they should buy it now, because there's going to be a severe shortage at the end of the year. So that shortage, if you think supply and demand in economics, is going to produce inflation, because there's going to be a high demand and not a lot of supply. So what do we know? Prices are going to go up. So, and when prices go up, it's going to look like the economy's heating up a little bit. It won't. And that's where we could get some interest rate inflationary pressure. But I think that goes away in the spring. So we'll see what happens.
You and the Fed Chairman Powell both think that. So,
I think it goes away.
he
I
is
think that's what
definitely
happens.
saying it's short term. So,
I agree, although I do think that in 2024, 2025, we're going to start paying. I wouldn't be shocked if we have another brief recession then. But that's what the CFAs in my office are saying now. So, and I don't disagree. Right now, the economy looks good. All the indicators are okay. You want to be a little bit defensive, but things look okay. And I think the Fed chair's right, you know.
mhm. So, anybody else with any questions for Mitch?
And this, by the way, is all presupposing that we don't have another COVID issue in November, December, which I hope we don't. So
Yeah, I don't know. I think we have another COVID issue right now, it seems like.
we might, but hopefully they get this under wraps and whatever happens, but hopefully it doesn't get worse.
Yeah. Oh, Lori is asking more about what you do, Mitch.
Yep. So Altium is a financial consulting company. We take people through a proprietary process that we call Vantage Point. That's essentially a 3-stage process. There's clarity, which is a forensic level look into what's going on in your financial world. I'll also send you a short video on this, Rosemarie. So it's about 1 minute and 17 seconds. It does a better job than I do. But at any rate, clarity is a forensic level look at what's going on. And clarity culminates in what we call a baseline future looking cash flow. So we look at everything a client's got, everything they expect to come in, and everything they want to spend through the rest of their lives. And we co-create this baseline future looking cash flow and give them idea what the future looks like. We then take that baseline future looking cash flow in the next stage, which we call creation. And that's where clients ask, what if? What if I buy 3 more houses? What if I sell my business? What if I retire early? What if I never retire? What if taxes go up, inflation goes up? Whatever it is, we can model it out right in front of the client. So what the client gets is a methodology for making decisions that lets them make them in line with their emotional stuff, but also in line with doing things more efficiently. Because both things are important, right? People make financial decisions for emotional reasons, not just financial reasons. We go to great lengths to understand the emotional reasons. So in the creation stage, that's the what if stage. So you get to see the ramifications of your decisions. So we can build a plan that comes true under the greatest variety of circumstances. That's what creation's all about. And then the last stage is action. So then the client says, okay, these are the things I want to do. These are the things I don't want to do. And we have to act as the accountability partner to make sure they get done. We also review things like wills, trusts, all that stuff, just to make sure it's all good. So that's essentially what we do.
So, Mitch, can you put your contact information in the chat?
Yep, I will be happy to.
And
So you want me to type and talk at the same time?
no, well, I'll talk for a minute while you're
Okay.
typing. Yeah, so as I said, I have used Mitch for probably 20 years now, maybe.
That's right.
Been a long time, and I have I have a lot of my family members, so I trust him, and he has definitely helped us grow our wealth outside of real estate. And I'm a big proponent of diversified streams of income. So I believe, although it's always a challenge for Mitch to get me to invest in things outside of real estate, we have definitely done things. We've done life insurance through Mitch that has been an investment vehicle for us. And Joe had a significant 401k, and I've recommended him to others in my family, at all different varying income levels, and Mitch has been able to help them all, and create the plan that worked for them. So, if you are looking for that type of advice, Mitch is definitely somebody I recommend. So he has put his information now
Yep.
into the chat. And let me see, I think we might have had maybe another question. Michael was asking, do you handle DSTs?
So the answer is I don't, and I'll explain to you why. Because remember, before I told you we don't have a broker-dealer affiliation, because when you're with a broker-dealer, your fiduciary responsibility legally is the broker-dealer. DST is a commission product. We don't handle commission products, certainly on the investment side. So I do not do DSTs. That's stuff that I will refer out.
And I guess you'll give me Eric's information. Eric actually does handle DSTs. He was supposed to be on the call. I think he had some time challenge today. So, but we'll put his information into the Facebook group.
And
So
I'll also make sure he's the one who I'm going to probably get educational information for you guys from. He really gets involved in nuts and bolts. I'm a good generalist. He's nuts and bolts. Like what Eric would do essentially is, let's say you had a building that you were selling. Like I have a client that's selling a building, or actually that deal is done. She came to me after that deal was done, in Brooklyn. She's selling a building. She now needs to do something with the money. And then Eric would help her find the different DST deals. So that's what Eric does essentially.
Brian, you have something?
Yeah, I do. I have a quick question, if you don't mind. Mitch, you were talking about development rights and PDR and started selling that, and I know about towns buying them, or or maybe even like land companies like open space institutes buying them. Are you talking about other companies or other entities that will actually buy open space or buy the development rights to the properties? And is that something that I could use for my landowners to potentially get money out or get them a tax break moving forward? Just
the answer is kind of, but not completely. So what ends up happening in those deals, and literally I was speaking to somebody who was a sponsor this morning. What happens in those deals is they'll identify the property. So they would buy the property from your landowner. Then they would get people to invest in the land. And then donate the land, and then ultimately sell it to the kind of folks who will buy it for, at that point, pennies on the dollar. It doesn't really matter because it's conservation property, and they're now responsible for the conservation property. I don't know. Does that answer your question?
It does. So that just gives me a good idea. So if I have an overpriced piece of property in a vista, go find some New Yorkers that have too much money and pull them together, get them to buy the property, and then have them donate to the land trust.
If you want to, if that's what you want to do, what I would say might be the better solution for you is, unless they want to donate the property directly, I would work with one of these companies, and I have worked with two of them, and I could give you the names of them, because they would buy the land from your client.
I think you typed in your stuff. I'll send you an email. That would be awesome. I'd love.
Yeah.
Just another avenue for our clients. That would be amazing.
Yeah. So Michael Packman is in Long Island, California, and Nate Phillips, I guess the company that he works for is really in Colorado, but those are the two companies that I'm familiar with that actually do these kind of deals.
Awesome. Thank you for your time. Appreciate it.
My pleasure. So yeah, happy to introduce you to him. All right, anything else, guys?
Mitch, thank you so much. I
Thank you.
really
Hope this was
appreciate your coming
informative.
on with us today, and I hope everybody did learn something. Maybe you didn't know about DSTs, and now you do. And we talked about some other great stuff. So again, Mitch, thanks so much for your time, and have an awesome day, everybody.
Thank you, guys. Appreciate your time. Take care.